Hello, my name is Andrew Pang. Welcome to another edition of CMS Forex News. Today is Wednesday, October 8th, 2008. The central banks of the US, Canada, England, and the Eurozone all cut their benchmark rates by half a percentage point, and the Swiss National Bank by a quarter point. This concluded an unprecedented meeting to coordinate efforts in handling the financial crisis. A joint statement by the banks noted that increased downside risks to global growth and diminished inflation warrants easing of monetary conditions. That puts the US rate at 1.5%, the ECB rate at 3.75%, the UK rate at 4.5%, and both the Canadian and Swiss rates at 2.5%. Japan did not participate, but offered its support for the coordinated effort. With commodity prices easing and global growth expected to suffer, inflation fears have been left behind in an attempt to shore up the global economy. Asian markets crumbled overnight, with the Nikkei 225 diving 9.4% to close at a four-year low. Investors are alarmed by the deteriorating financial situation and the inability of banks to lend to each other. The Aussie yen pair, a vehicle for carry trade, plummeted overnight, falling 800 pips to test the 63.60 level, before recovering in the wake of the central bank announcements. The fall followed Monday's drop of almost 1,000 pips. The Aussie hit a new five-year low against the dollar, as well as it plunged about 650 pips overnight. In fundamental news from Australia, consumer confidence fell 11% for the October period as Australians are unnerved by the financial turmoil. The survey does not include the large interest rate cut we saw earlier in the week from the RBA. Home loans for the August period were down 2.2%, and the number of loans is now at a 7-year low. Moving on to Europe, in addition to its rate cut, the Bank of England will also make £50 billion in emergency loans available to its banks as part of a government bailout. In return, the bank will get preference shares. This is an attempt to recapitalize British banks, which have seen their values hammered in the UK stock exchange. After a pause yesterday, the pound fell further against the yen, which is the big winner from all of this market turmoil and increase in risk aversion. From its open, the pair was down as much as 500 pips in a rather volatile session. The pound was also weaker against the dollar, sliding more than 300 pips from its intraday high overnight. It fell to test the 1.7260 level in New York afternoon trading. The London FTSE 200 index was off about 5%, as investors were not swayed by any of the moves seen today. Stocks in Europe, as measured by the DJ Stoxx 600 index, were off 6%. In the U.S., pending home sales surprised on the upside, rising 7.4% on the month and up 8.8% on the year. Economists at the National Association of Realtors, which puts out the release, attributed the rise to more affordable home prices and declining mortgage rates after Fannie Mae and Freddie Mac were nationalized. In the look at one more yen pair, the dollar-yen fell below the 100 level, sliding 280 pips from its open to test 98.60, a 7-month low. U.S. stocks rose initially, fell throughout the morning, then rallied into the green in the afternoon. The U.S. dollar-Canadian dollar pair rose above the 1.11 level today, following a rally of about 200 pips. The pair has steadily moved in the dollar's favor, as the implications of a global slowdown means the price of Canadian commodity exports will fall. Oil was down more than $3 at one point to fall below the $87 a barrel. Finally, the euro-dollar pair had a second day of increases, moving above the 1.37 level. The pair was trading near 1.47 only 8 sessions ago and may have found a temporary low. Tonight, Australia posts its employment report, and overnight we get trade balance data from the UK and Germany. Early tomorrow morning, the UK decides on rates, though with its cut today, it is unlikely policymakers will move again tomorrow. Meanwhile, the US releases its jobless claims and wholesale inventories. And that wraps it up for the day in Forex News. Join us again tomorrow right here at cmsfx.com.